So welcome back after the break. Question number 34 in front of us. Let's have a look on that. The current EPS of VEE Limited is rupees 4 and the company has shown an extraordinary growth of 40% in its earning in the last few years. EPS 4, the growth rate has been 40%, but that is the past, not the current. This high growth rate means the 40% is likely to continue for the next 5 years, after which the growth rate in earnings will decline from 40% to 10% during the next 5 years. Just understand, it will decline from 40 to 10. That means there will be a declination of 30% in 5 years, and after that it will remain stable at 10% perpetually. Next line is very important, that this 30% which is going to decline is not in one shot, it is going to be similar and linear. Just go through the sentence. The decline in growth rate during the 5-year transition period will be equal and linear. The decline will be equal and linear stage wise. Okay, so let's calculate one thing. If the growth rate is going to decline from 40 to 10, that means the decline will be 30% in 5 years, and it should be equal and linear. That's why 30 divided by 5, that means every year the growth rate will decline by 6%. Okay, similar type of questions has been discussed by us in the previous two part. Currently the company's payout ratio, till this point it was all about the growth. Till this point growth rate was 40%, then it will decline. Let's just start writing it. I think question 34. So first year, second year, third year, fourth year, fifth year, then sixth year, seventh year, eighth year, ninth year, 10th year, and then something called as perpetuity starts. Okay, so this is how it looks like. First, second, third, fourth. First, second, third, fourth, fifth, sixth, seventh, eighth, ninth, and 10th. Okay, let me write down the growth rate. Forty. Now it is going to decline linearly, equally for the next 5 years till 10%. That means 30%. 30 divided by rest of the 5 years. That means 6% every year there will be decline. So 40 minus 6, 34. Again minus 6, 28. Again minus 6, 22. Again minus 6, 16. Again minus 6, 10. And then 10% every year. Stabilize. Now comes the payout ratio, dividend payout ratio. Okay, the current EPS is given to you, which is 4 rupees. Now comes the dividend payout ratio. Currently the company's payout ratio, have a look. Currently the company's payout ratio is 10%, and it is likely to remain the same for the next 5 years. So the dividend payout ratio will be 10%, 10%, 10%, 10%, and 10% for the next 5 years. Okay. From the beginning of the 6th year till the end of the 10th year, the payout ratio will linearly increase. Underline the word linearly increase. Now there are two things which are linearly changing in this question. So this is quite difficult. And if you understand question number 34, you don't have to do all the previous question till question number, I think 30 or something, 28. From 28, right? So this one question, you revise this one question and you can remove all the question from question number 28 to 33. Okay. So the dividend payout ratio will increase, and that too linearly, not just in one shot, but linearly, and stabilize at 50% at the end of 10th year. So understand, we have to increase the payout ratio from 10% to 50% by the end of the 10th year. So 50 minus 10, that means we have to increase it by 40% in 5 years. That means every year it should increase by 8%. 18, 24, sorry, 26, 34, then 8 means 42 and 50. Then it will stabilize at 50% at the end of 10th year and stabilize. Okay, the post tax cost of capital, stabilize means it will be same, means after that the dividend payout ratio will be 50% only from that point onwards. Okay. The post-tax cost of capital is 17%. The present value factors are given to you in 3 decimals. You are required to calculate the intrinsic value of the company, and rest of the things are same. That is, market price is given to you. Actual market price, you will have to advise whether the shares should be purchased or not. That's it. It's very simple. But then there are 2 things to discuss. You will have to first calculate the earnings of every year with this growth rate, and after that apply the DPR on that earnings to arrive at the dividend, and then discount all the dividends. And see, if you want to calculate the market price, please understand at this point you will have to calculate the market price of all the dividends till 10 years, and then at 10th year you will have to calculate MP10. In the previous question, what we used to do is we used to take one less year. So if the question says 8 years, we used to calculate 7-year dividends and 7th year market price, because after 7th year, everything would have been, everything was same. But in this case, there is a change, there is a shift from 42 to 50. So we are going to do the calculation for 10 years altogether. But we can restrict the calculation at MP9 also. I think we can do that because everything is same. Growth rate is 10%, 50% is dividend payout ratio after this year. So we will just try to solve the question by taking MP9 also. Okay. Let me see what has been done in the question. We can do it opposite ways. Yeah, they have taken all the dividends for 10 years. So what I will do is I will just try to uh, show calculate the same answer by taking the dividends up to 9 year only. So my calculation will be dividend for 9 years and the market price of 9th year. I think we should get the answer with that, and we can avoid one more calculation. Let's do the calculation. I think now it's very easy, it's not that difficult. What you can do is you can just draw the table here, or we can just write it like this: year EPS. First of all, let's start from 0, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 and 4. So what we are going to do, we want to add 40% for the next 5 years. Just see what I'm going to do it here. Have a look. Because I want to add 40% every year, I am going to do it like this: 1.4 into 4 equals to 5.6 equals to 7.8 equals to 10.98 equals to 15.37 and then again equals to 21.51. From this point, the growth rate every year is changing. From this point, the growth rate every year is changing. Okay, and that's why we will do the calculation now individually. So 21.51 multiplied by 1.34 goes to 28.83 multiplied by 1.28, 36.90 multiplied by 1.22, 45.02 multiplied by 1.16, 52.22 multiplied by 1.10, 57.44. Okay, now comes the dividend per share. It was 10% for the first 5 years, so it goes to 0.4 if I'm right. then 0.56, 0.78, 1.10, 1.54, 2.15, then 2 point, okay, sorry, after fifth year it starts increasing by 8% every year. So on the sixth year it will be 18%, 26%, 34%, 42%, and 50%, right? Let's just calculate it. 28.83 into 0.18, 5.20, or 19, sorry. 36.90 into 0.26, 9.59. 45.02 into 0.34, 15.31. 52.22 into 0.42, 17.73. Then 57.44 into 0.50, 28.72. Getting it? There is some mistake. 52.22 into 0.42 is 21.93. 45.02 into 0.34 is 15.31. Okay, so these are the dividends for every year. Let's just write down the present value factor given in the question, those which is given in the question, not by the calculator. Okay, 0.855, zeroth year doesn't matter to us. 0.731, it should not also be taken into account, zeroth year. 0.534, 0.456, 0.390, 0.333, 0.285, and 0.244, and 0.209. Okay. So these are this way we are going to reach at the present value of all the dividends. Present value of all the dividends. Let's just calculate and understand that I'm going to put every figure in the memory. So how I'm pressing the keys: 0.56 into 0.855 m plus, it gives us 0.48. 0.78 into 0.731 m plus, 0.57. 1.1 into 0.625 m plus, 0.69. 1.54 into 0.534, 0.82. 2.15 into 0.456, 0.98. 5.19 into 0.390, 2.02. 9.59 into 0.333, 3.19. 15.31 into 0.285, 4.36. 21.93 into 0.244, 5.35. 28.72 into 0.209, 6 rupees. If we do the total, it gives us 24.47. Let me just do it once again, just to cross check. Yeah, 24.46 is the total of, if we do this. Otherwise on the calculator it is 24.47. just let me make it 24.46 for the sake of understanding. This is the present value of all the dividends, but at the end of the 10th year we have to calculate the market price also. We can calculate it easily. MP10 is equal to, in order to calculate MP10 we need the dividend for the next year, 11th. D11 divided by cost of equity minus growth. So what do you think the D11 will be? Because after 10th year the growth rate is same, that is 10%. So we will take the dividend of 10th year, which is 28.72. 28.72, and add the growth in that. which is 1.10. Then the present value factor at which rate? 17%. 0.17 minus 0.10. Let's just calculate. It gives us 451.31. And this is MP10. If we calculate present value of MP10, it will be 451.31 into 10th year factor, which is 0.209. And this gives us 94.32. So the present value of future cash flows are these two. Now you can calculate MP0 as 24.46 plus 94.32, and that goes to 118.78. This is your market price. Okay, let's just cross check with the institute. It is 118.75. Ours is 118.78. That is just the rounding of error. So all the calculations are right. Now let me take you to one more different approach. Instead of calculating the 10th year cash flow, what would have happened if we would have restricted our calculation till 9th year only? So in that case, we would have taken the total of these two, or I can just deduct 24.46 or 6 rupees from 24.46. This gives me around 18.46 of the total. Okay, one figure has been arrived. After that, I would have calculated MP9, not 10. Okay, so MP9 would have been dividend 10 divided by cost of equity minus growth. For 9th year, we need the dividend for 10th year, right? And dividend for 10th year is 28.72 till this point, divided by 0.17 minus 0.10. If we do the calculation, it gives us the value of 410.29, means this figure. After that, we are going to discount MP9 with the 9th year factor. Okay, then we come with the present value, that is 410.29 with 9th year factor. Are you understanding? 9th year means 0.244, and this gives us another figure, 100.11. So we have two figures from this calculation, 18.46 and 100.11. Let's just do the total of all those. It will be MP0 is equal to 18.46 plus 100.11, 118.56, almost same. This figure and 19.7. That means you can reduce your calculation till MP9 also, because after 9th year you can clearly see everything is same. After 9th year, growth rate is 10% throughout. After 9th year, dividend payout ratio is 50% throughout. So you can restrict your calculation till 9th year also. This is how we have to calculate. I think it was the same question. There is nothing new that you have learned in this, except for the fact that the growth rate is declining and the dividend payout ratio is increasing in this question. So if you understand this question, all the previous question, means from 28 onwards, are just easy for you now. So this was question number 34. We have ended with this. Since now we have to compare that also, right? You can see our market price of the share is 125, actual market price, and we are saying that it should not be more than 118.75. So at this point, this is overpriced. Can we say it as overpriced? Yes, sir, we can say it as overpriced, and we can reject it totally. So it is not advisable to invest in the share because it is overvalued. In market, it is selling at somewhere around 7 to 8 rupees costlier. According to us, it should be only 118.75. So this was the question. With this, we end our sequence of multi-stage dividend discount model. Have a look on this. We started the two-stage dividend discount model from question number 28. We saw all those things. After that, question number 32, 33, 34, you can see 5-stage, 6-stage dividend discount model. There were many different types of stages. Now the next three questions are going to be little different, but we are going to enjoy that. Before taking a break, or before moving over to the new type of questions, these three are the important ones. Question number 35 is going to be the next. Have a look. Now let's read it. Interesting question. Very interesting question. A different situation is given to us here altogether. So Sam Limited has just paid a dividend of rupees 2 per share. What you are going to underline, just paid, and just write down D0 because it is a thing of a past. So dividend of rupees 2 is for the past year, and it is expected to grow at a rate of 6% per annum. After paying the dividend, the board declared to take up a project by retaining the next 3 annual dividends. First of all, they declared the dividend, board of director, which was 2 rupees, which was for the past year, and then it is expected to the board that this dividend will grow at a rate of 6% per annum. So 2 into 1.06 into 1.06 and into 1.06. But after all this happened, they are thinking to take up the project, and for that project the investment will be required, and investment will have to be funded from the earnings. And if you fund the investment from the earning per share, you will not be able to pay next 3 annual dividends, next 3 dividends. So you will not be paying anything for the next 3 years if you take up the project. And it is expected that this project that you are taking up, that the company is taking up, is of the same risk as the existing projects. Okay. The results of this project will start coming from the 4th year onwards. So from the 4th year, you will be looking for the cash inflows. And then the dividends will then be 2.5 rupees per share. Instead of 2 rupees, it will be 2.5, and then it will grow at 7% instead of 6. So understand, if you sacrifice 3 years dividend, from 4th year you will get 0.50 extra. And the growth rate in that will also be 1% extra after that is 5th year onwards. So you need to decide whether you are ready for the sacrifice or not. An investor, let's say an investor like you and me, has 1000 shares in Sam Limited and wants a receipt of at least 2000 rupees per annum from this investment. You have 1000 shares. And what just happened for the past year, 1000 into 2 rupees. This is what the dividend that you have received. And the company is saying that there will be no dividend for the next 3 years. In this case, you will be in trouble because you need 2000 rupees per annum in any case. So when an investor invests in the shares, there can be only 2 ways from which he can get his money. First, annual dividend. And if the dividend is not being paid by the company and you still want cash from that investment, you will have to sell the shares. Out of 1000 shares, you can sell some shares at that market price. First year end market price, second year end market price, third year end market price. Sell so much of the share that the total receipt to you becomes 2000 rupees. That's it. If you anyhow want, an investor wants 2000 rupees anyhow, even though the board is not paying the dividend and investor is demanding the money, how is it possible? Only by selling the share. Because owner of the share is investor and he wants money, he will sell the share if he is not getting the dividend. Okay. Evaluate whether the market value of the share is affected by the decision of the board. First, let's talk about the company's share price. If the company does not take up the project, every year they will be distributing 2 rupees of the dividend with 6% growth. I agree. In that case, what is the market price? And then Forget about the next 3 years. Take up the project. Forget about the dividends of the next 3 years. Start from the fourth year, which is 2.50 with a growth rate of 7%, and then tell me what is the price. Compare both the price and then say whether the price is affected or not. Okay. So how we are going to calculate the market price for both the parts? Okay. Second thing is given to us, which I think we should read it first. Recommend how investor can maintain his target receipt. What was his target receipt? 2000 rupees per annum from the investment for the first 3 years. So for the first 3 years, when the company is not going to pay dividend, how an investor can get the receipt of 2000 rupees per annum? Write down, sell shares. This is the only way to have some receipts for the first 3 years, and then improved income thereafter. Improved means more than 2000. So for the first 3 years, the income was 2000 only. Now, so basically speaking, receipt. And after 3 years, how the receipts are more than 2000. Given that the cost of capital of the firm is 8%. So you need to consider this cost of capital. Okay. We will first solve the question. First part. The first part says that whether the market value of the share is affected by the decision of the board. In order to say whether it is affected or not, we have to calculate the price before taking up the project, price after taking up the project, right? So first of all, question number 35, we can say the current price is very simple. Market price is equal to D0 in bracket 1 plus growth divided by cost of equity minus growth. 2 rupees is the past dividend, 6% is the growth rate, cost of equity 8%, 6% is the growth rate. It will be, the market price right now is 106%. Market price after taking up project. So understand the timeline here. First year, second year, third year, and then perpetual. Okay. There is no cash flow. You have to calculate MP0. There is no cash flow for the first 3 years. The very first cash flow that you will receive is at the end of the fourth year, which is D4, which is going to be 2.50. So if you have D4, what exactly will you calculate? MP3 with the help of D4. There are two things. Either you calculate MP3 and discount it, or you take D4 and calculate MP4 by taking D5 and then discount these two figures. This is first method, this is second method. From both the methods, the answer will be same. So why I should increase my calculations? Okay. Why I should waste my time? I will just go with MP3. Okay, so MP3 is nothing but D4 divided by cost of equity minus growth. D4 is 2.5 rupees. Okay, cost of equity is 8% and the growth rate is 7%. Am I right? The growth rate is 7% in after taking up the project. Okay, and D4 is already given to us, which is 2.50, and if we are calculating MP3, the growth is already included in 2.50. The growth is already included in 2.50 for MP3. For MP4, we will need D5 and then we will have to add growth in 2.5. If you add growth in 2.5, let me be very clear, it will be D5. It will become D5, and with D5 you can only calculate MP4, not 3. Okay, so if you do the calculation, it becomes 250. So yes, the market price is changing from 106 to 100. We have to calculate the present value also, right? So this is just 250 market price for third year end. But now we have to take it to 0th point. So 1 divided by 1.08 to the power 3. Or you can write it like this, 250 into present value factor at 8% for third year. This is just how you can present, how you want to present in the exams. 1 divided by 1.08 1, 2, 3 equals to 0.794. So it becomes 250 into 0.794. The answer is 198 point around 46. So yes, the market price is changing from 106 to 119.46. Let's have a look at the answer. See, it is changing from 106 to 119.46. So we can conclude that yes, the market price is being affected. That was the first answer. Second answer is we need to tell them how many shares has to be sold every year. How many shares has to be sold every year so that an investor can get 2000 rupees. Now understand my point. Second part. First year, second year, third year. In all those 3 years, investor needs 2000 rupees, right? And he will have to sell the shares. He will have to sell the shares at a market price. Relevant market price, we can say relevant market price. With the help of this, you will arrive at number of shares which needs to be sold. Number of shares which needs to be sold in order to get a receipt of 2000 rupees. Now you will understand one thing, that we have already calculated MP3, which comes to 250. We had already calculated. This is the figure. MP3 250. So the one figure is ready with us. Now tell me one thing. In the previous part, what you did was you calculated MP0 with the help of MP3. Like this. You calculated MP0 with the help of MP3. Can't you calculate MP1 with the help of MP3 and MP2 with the help of MP3? MP1 and MP2. Yes, we can do that. So which present value factor will be used in order to calculate it? Sir, very simple. If while calculating MP0 from MP3, we had to go back 3 years, 1, 2 and 3. So we took third year factor, present value factor for 3 years. If we have to go back 2 years, we will take only second year factor. If we have to go back 1 year, we will take first year factor. Simple. So with the help of this 3, we can calculate MP2 as well, MP1 as well, because we did the same with MP0. So let's just do it and find out the answer. So market price at the end of third year is 250. Market price at the end of second year is MP3 into present value factor for first year at 8%, which is 250 into, what is the present value factor given to us in this question? Do you think these are given? No, these are not given. So we will take it on our calculator. 1 divided 1.08. Only 1 year factor is required. 0.926. So it gives us the figure of 231.50. Then we will calculate MP1 as MP3 into present value factor for second year at 8%. 250 into 0.857. 214.33. So we have all the 3 values at which we can sell the share. These are the prices. These are the prices of respective time at which we can sell the shares. So therefore, the final answer is here. Year 1, 2, 3. Receipt that we need is 2000 in each case. Okay, market price 214.33, 231.50 and 215. The number of shares to be sold. You will get an idea. See, if you divide 2000 by 214.33, it will give you a figure of 9.33. That is how much? Round it off to 10. You cannot round it off to 9. You cannot say that 0.33 is closer to 9, that's why we will round it off to 9. No. We need receipt of at least 2000 rupees. The word at least itself means that if you are getting more receipt, then it's all fine. But do not dare to take lesser receipt than 2000. So if we sell 9 shares, the receipt will be lesser than 2000. Let it be more than 2000 na? So sell 10 shares. In the same way, 2000 divided by 231.50, it gives us 8.64, which is 9, and 2000 divided by 258, that means 8 directly. So we have to ultimately sell this much of the share to receive 2000 every year, and after that, that is from 4th year onwards, DPS of 2.5 will be received, which we can say will be received, which is totaling to, understand, you had 1000 share, you sold 10 share first, then 9, then 8. That means you only have 973 shares on which you will be getting 2.5 rupees of the dividend, which goes to 2432.5, which is more than 2000 rupees. Do you agree or not? You sold 10, 9 and 8 shares in the respective years, then you are just left with 973 shares in 4th year when the dividend of 2.5 was given. So you will be receiving only 2432.50. This is what is given here. You can clearly see 250, market price 321, 1098 is the number of share that you sold, and after that 2432.50 is the earning that you are receiving, which we can say improved earning. From the first 3 year it was 2000, 2000, 2000 na? From 4th year onwards you are getting 2432.50. You are getting more. Agreeing to it. So this is it. This is the end of the question, and this is how the purpose is achieved. Purpose was to get 2000 rupees each year in the first 3 years and then improved income. So sell the shares 10, 9, 8. Okay. End of the question. Let's move on to the next question. We have a lot to do in this. Question number 36. Have a look. Mr. A is thinking of buying shares at rupees 500 each face value. 500 each at a face value of 100. Okay. Of a face value of 100. He is expecting a bonus ratio of 1:5 during the 4th year. The total period in this question is 7 years. For the first 3 years, there is no bonus ratio. But then on the 4th year, if you have 5 shares, you will get 1 as bonus. So if you have 5, you will get 1 as bonus. What if you have 1 share only? You will get 0.20 as bonus. But then you might raise a question. Sir, shares cannot be distributed in decimals. I agree with that thing. For the purpose of calculation only, we are going to make it easy and take 0.20 and 1. Otherwise, in reality, it will be in whole number. Okay, good. Annual expected dividend. Expected dividend is 20%, and the same rate. If it is rate, that means it will be applied on the face value. We have learned this in Walter's model. There are 3 types of dividend. First is the rate, second is the yield, and the third is the payout ratio. And I think payout ratio is something that we have used most of the time, right? Rate is applied on face value, yield is applied on market price, payout ratio is applied on EPS. So this is the rate, and this rate will be applied on face value. So the dividend amount comes to 20 rupees. So for the first 3 years, you will be getting 20 rupees. But then you will be getting a bonus share in the 4th year. So in the 4th year, you will be having in total 1.2 shares, not just 1.2. And for 1.2 shares you will be receiving 24 rupees. 20 into 1.2, 24 rupees as the dividend for 4th, 5th, 6th and 7th year. Okay, at the end of the 7th year, Mr. A is thinking that he will sell the shares at 900 rupees each. The word each is important. At the end of 7th year, you have 1.20 shares, not just one. 1.20, and you can sell those shares at 900 rupees each. So 900 into 1.2 will be the selling price. That is 1080. So this is another cash inflow to you. Till this time, if you remember, if you can imagine the calculation and the dividend received, first year 20, second year 20. See, first 20, second 20, third 20, then 24, 24, 24, 24. Why 24? Because you received bonus share in the fourth year. So from the fourth year it became 1.2 into 20. Okay, that's good. Great. In the last year, you will be receiving 1080 rupees by selling all the shares. But the question says that there are some incidental expenses related to purchase and sale, which is 5%. That means the moment you will sell the share, you will have to pay 5% as the expenses. So let's just reduce the 5% and we will be left with 1026. Am I right? 1026. 900 rupees is the selling price, total number of share 1.2, and we are reducing 5%. So we are only taking 95% of that. Okay, so these are the cash flows. Now, what is the question, sir? Should Mr. A, he expects a minimum rate of return of 12%, that becomes the cost of equity to us. Should Mr. A buy the share? In order to buy the share, the price is 500 rupees, and today we will be buying only one share, but we will be selling 1.2 share because of the bonus. If so, what maximum price should he pay for each share? Assume no tax on dividend income and capital gain. So there are two questions which we have to answer in this part. First, whether we should buy it or not. So understand the process. Question number 36. It all depends upon the actual market price and the theoretical market price. Actual market price is 500. Theoretical market price is what we have to calculate. So how are you going to calculate the price? It is nothing but the present value of all, or we can say present value of future cash flows. Right? 1, 2, 3, 4, 5, 6, 7. So whatever will be the price today, you will be paying 1.05 times of the same. Am I right? Because there are incidental expenses attached to it. So if 500 rupees is the price, you will be paying 525 rupees today. Okay. Now let's just calculate the present value. I will just take it at the end. Let's just calculate the present value of all the future cash flows. So first year, second year, third year, fourth year, fifth year, sixth year and 7th year dividends. D1, D2, 3, 4, 5, 6 and 7, and then selling price. So 1026, the present value of that. You have the present value rate 12%. You can do the calculation. These are 6 years dividend. This is the 7-year dividend. This is the 7th year's cash flow. If you take the discounting rate, you arrive at a price of 563.68. So this is the present value of future cash flows, whether you should buy the share today or not. See, in terms of present value, the cash inflow to you is 563.68. And in terms of present value, the cash outflow to you is not 500 only. The moment you will go and buy the share, it will cost you 1.05 times. That means 525. So I'm paying 525 today for receiving 563.68 in today's term in future. So yes, it's a good deal. It's a good deal. We can say it's a very good deal because the outflow is lesser than the inflow. You can clearly say here is that if you want to calculate instead of 500 we will just take the outflow. So we can say 525 is lesser than theoretical value, which is 563.68. So hence we should buy the share, because in actual market we will have to pay lesser amount. You agree on this? Second part, I agree that you are ready to buy the share at 525. Will you be ready to buy the share at 530? Yes, sir. 540? Yes, sir. What is the maximum amount on which you will be ready to buy the share? 563.68. Maximum outflow where we are ready to buy is 563.68. But do you think the question is asking this question? No, question is not asking about this. Question is asking maximum price of share where we are ready to buy. Sir, what is the difference in two sentences? The first one says about the outflow, second one says about the price of the share. Question is asking you the price of the share. So, is this not the price of the share? No, sir, this is not the price of the share, because this includes incidental expenses. This is the maximum outflow that we can afford. But what is the price of the share that we can afford? Maximum price of the share. See, it's very simple. Price of the share at which we are going to buy will attract 5% charges, whatever will be the price. And after that also, the outflow should not go beyond the maximum permissible. So let's take it as X, 1.05 and 563.68. This will give you an answer of X is equal to, and I will explain it, 536.84. This is the maximum price of the share, above which if the share price goes, you will not buy the share. Because understand, the moment this price reaches at this level, you will know that you will have to pay 5% more on this amount, which will bring your total outflow to 563.68 to buy the share. And this is the only 563.68 is the only amount that you are getting after investing in this share. So if the inflows are not more than 563.68, the outflows should also not go beyond. And outflow means the price that you are paying and the 5% charges as well, and any other thing. Outflow means outflow, the total that you are paying. So you are not just paying the price of the share, you are also paying the incidental expenses in the beginning. So all things included, the outflow should be maximum this. So that's why what we did is we considered this to include 5%. That's how we have calculated. See, since Mr. A, just forget about it and see here, 563.68 divided by 1.05, you can say, you will get 536.84. This is the price and this is the outflow. There is a difference. In actual, you will pay the price, you will pay the expenses, and then it will become the outflow. The question is asking you about the maximum price. Please understand, they are not asking you the maximum outflow, they are asking you the price. So it goes like this. See, 500 is the price plus, or we can say incidental expenses 1.05. This is going to be your outflow, 525 today, but your inflow is 563.68. This is after taking the present value of D127 and market price 7, right? So if you are not, this is your present value of cash inflow, and this is your present value of cash outflow, and this is your price. The question is not asking you about the outflow, they are asking you about the price. Understand, what should be the price? Instead of 500, keep it X into 1.05, so that these two value become equal. you are not going to pay more. Outflow should not be more than inflow. That's what we say, na? Ki inflow is restricted. See, if the inflow is restricted to 563.68, the outflow should also be restricted to 563.68. So solve this question and you will get the X. You will get the X, the maximum price where the total outflow will go to 563.68, because that's the last point we can afford from our pocket. Okay, let's just move on to the last question of this lecture, and then we will just end up with our one part of it. You are interested in buying some equity shares, so please understand this. The entire part, first paragraph, is just something which they could have given in a table format, which would have been easier for the student to understand. So although this question may look lengthier to you or bigger to you, but it is not in real sense. The entire first paragraph can be easily converted into a table values. We will do it. You are interested in buying some equity stocks of RK Limited. So there is a company called as RK Limited. RK Limited has three different divisions. Okay. A, B, and C. Division A, Division B, and Division C. And all the three divisions are in different industries. You just imagine RK Limited as Conferenza. Okay. There is something happening. Okay. RK Limited is Conferenza. And these are the three divisions. Let's say video lectures. Second one is we can say real estate. These are the only two things right now going on. But let's assume the third one as food industry. I'm not into it yet, but let's assume it. So we can say that this company is into three different industries altogether. Video lectures and books comes in one industry only. So I have not taken the books wala part. So these are the three different industries. So in the similar way, RK Limited has three divisions which are in three different industries. Now understand. Division A captures 10% of its industries sales, not companies sales. Industries. It means the other competitors also included, which is forecasted to be 50 crore. So for the industry, that means that for the entire industry, the total sales is 50 crore and we could capture only 10% of it. We can capture only 10% of it. Division B and C can capture 30% and 2% of their respective industry sales, which comes to 20 and 8.5 crore. So understand. It goes like this. Division A, B, C and sales. Can we say 50 crore? No, sir. 50 crore into 10%, which means 5 crores. And then 20 crore into 30%, which means 6 crore. 30% or what? Yeah. And 2% of 8.5 crore. 8.5 crore into 2%. Around 0.17 lakhs or something. Yeah. So these are the total sales of division ABC of RK Limited. Good enough. Then let's start from here now. Division A traditionally had a 5% net income margin, whereas B and C had 8 and 10% net income margin. So we can clearly write down NIM, net income margin, 5, 8 and 10. 5%, 8%, 10%. We can clearly say the profit after tax here is 5 into 5%, which means 25 lakhs or 0.25 crore, 48 lakhs or 0.48, and this will be 0.017, I think, or 1.70 lakhs. In another sense, we can write down 25 lakhs, 48 lakhs, and 1,70,000. The total profit of the entire company is 74 lakh. 70,000. Are you getting it? This is the table that they could have given easily and we would have understood. RK Limited has 3 lakh shares of equity stock outstanding which sells at 250. See, how many shares? 3 lakhs. This is your profit after tax. This is number of share. What do you think will arrive if we divide profit after tax by a number of share? It will be the EPS, which is 24.90. The current market price is 250 rupees. Okay, good enough. Now comes the second part where we are going to use a lot of information. The company has not paid dividend since it started its business 10 years ago. Okay, I agree with that thing. However, from the market sources, you come to know that the RK Limited will start paying dividend in 3 years time. Not in the first year, not in the second year, but you can see the cash inflow. You will be able to see the cash inflow from third year. And the payout ratio is 30% of EPS. So whatever will be the EPS in third year, of that 30% will be paid as dividend. Expecting this dividend would continue. Expecting this dividend, you would like to hold the share till the end of the 5 years. Okay, good enough. Just backing up. By analyzing the past financial statements, you have determined that the company's required rate of return is 18%. PE ratio will be 10. PE ratio will be 10 for the next year and 20 for the 5th year. Cool. Would you purchase RK Limited equity at this time based on your 1 year forecast? If I just consider 1 year, there is no dividend that they are going to pay. The dividend will be paid at the end of the third year, not the one year. The only 1 year information is this, that the PE ratio will be 10. That means whatever I am earning today, the market price will be 10 times of this EPS at the end of the first year. Let's just wait for a minute. I think this will sort it out. Or let me solve it here itself. So considering that fact, at the end of the 1 year, your PE ratio will be 10. EPS you have already calculated as 24.9. So you can clearly say that the market price will be 249 at the end of the first year. Okay, good. But tell me one thing. Today's market price is 250. You will be paying 250 rupees today to get 249 after a year. This seems fair to you? No, sir, not at all. So 10 into 24.9, that goes to 249. And if you take the present value of it, you will have to multiply it with first year present value factor, that is 0.847. So 249 into 0.847 goes to 210.9. Just imagine you are paying 250 rupees today to get 210.9 rupees immediately. Is not worth. In fact, we do not have to calculate the present value also. We can clearly see 250 is more than 249 that we are going to get after 1 year. At the same time itself, we will say no to this particular share. I won't purchase RK Limited share if I'm paying 250 and getting 249 after a year. No, sir. The present value of it is even lesser than the cost that I'm paying right now. You might raise a question that if the PE ratio is 10 after 1 year, you should have used the EPS of first year end, not just the 0th time. But the thing is, this EPS is of 0th time or the sales is of first year end is not given anywhere. So you can assume this EPS is of 24.9 as of first of all first year end. Otherwise also there is no growth, so you can take that 24.9 only. So this is the only solution. Okay, cool. I agree on that thing. So first part is very easy to understand. I think this is not going to work. So let's just finish our calculation here itself. Now, if you expect the earnings to grow at 15% continuously, how much are you willing to pay for the stock of RK Limited? Let me just Okay. Now comes this part, second part. How much I am willing to pay for the shares. That means the theoretical market price or the maximum price or the fair value or the intrinsic value that they are asking. How much I am willing to pay for the share? The maximum that I am going to receive in terms of present value. And when I buy the share, in the first year I'm not going to get anything, in the second year I'm not going to get anything, in the third year I will be receiving dividend, which will be 30% of the EPS. So understand, EPS, if it is 24.90 today, it will grow by how much? Can I say it as 15%, right? So what you have to do is, it will grow by 15%. 24.90 into 1.15 goes to 28.64 into 1.15 goes to 32.93 into 1.15 goes to 37.87. Okay, we got the EPS of the third year. Then calculate the dividend payout ratio, which is 30%. We will get the DPS of the third year, which is 11.36. And this 15% is nothing but the growth rate. You get it? So this is your D3. With the help of D3, which type of value you can calculate? You can calculate MP2. Do you understand that thing? So MP2 is nothing but D3 divided by cost of equity minus growth. 11.36 divided by, what is the cost of equity? Rate is 18%. So the cost of equity is 18%, growth rate is 15%. You will arrive at a market price at the end of year 2, which goes to 378.67. This is the market price at the end of year 2. What you have to do is, you have to calculate the market price at 0th point from the market price at second year. You just discount this price by 2 years. The second year factor is 0.718 in this question. You can just look at it. So 0.718, you will just multiply that figure and you will arrive at 271.88. This is your market price. This is the maximum that you will be ready to pay. And it's very simple. Let me tell you one thing. MP0 is nothing but MP2 multiplied by present value factor at 18% for second year. It's that simple. MP2 is nothing but D3 divided by cost of equity minus growth. This should be the presentation in exam, into 0.718. D3 is nothing but EPS 3 into 30%. Are you getting it? Divided by cost of equity minus growth into 0.718. Again, EPS 3 is nothing but today's EPS. EPS 0 in bracket 1 plus growth to the power 3. Why 3? Because we want to go from 0 to third year EPS. So we will take the growth and compound it by 3 times. Divided by cost of equity minus growth into 0.718. Now let's just put down the figure. 24.9 in bracket 1.15 to the power 3 divided by 0.18 minus 0.15 into 0.718. Again, 1.15 into equal to into 24.90. So it looks like this. 30. Okay. Yeah, I am missing this 30% here. So let's just put it 30%. So 37.87 into 30% is the dividend of that year. Your answer is ready. 271.91 roughly, if you directly calculate it. That is the end of the question, second part, if you start from this to this. But for that purpose, you should know the process now. Why I got to know that I have to start from MP2? Because question clearly says that from third year onwards, the dividend will be paid and it will continuously grow at the same rate, 15%. So D3 is used for which type of market price? The second year market price. And that's it. The second year market price has to be brought down to 0th point and you get the answer. See, You just focus on the answer 271.83 here, and our answer is 271.88 there, or 271.91 here. So rounding of errors are there, but the method followed by institute is lengthy. They took the fourth year also, fifth year also. There was no need for that. You can just take MP2 into present value factor for second year. That's it. Instead, I will say take the sixth year also. Na, you will get the same answer. See, by keeping the calculation simple, calculating the present value of second year price, we got the same answer. Why to do all this calculation and waste our time in exam? Exactly, that is the reason. So this is the end of our question number 37. You got the answer. Question number 38 onwards, we are going to see multiple concepts. So we have ended similar type of questions. H model is another where we are going to just learn it. Then the concepts will start differentiating. Like there will be a difference in lots of concepts. So from here we are going to break, after H model and IRR method, we are going to break the continuity of the dividend growth model. Bye bye for now.